Amidst soaring debts and ambitious expansions, EQT Corp stands at a critical juncture. Is the spike in liabilities a warning sign or a catalyst for future gains? We'll delve into their financial maneuvers, including massive asset divestitures and bold bets on natural gas to reveal surprising insights that could impact your investment decisions. Ready? Let's go. EQT Corporation, founded in 1878 and headquartered in Pittsburgh, is a major natural gas producer with substantial reserves in the Marcellus play. Its significant market capitalization reflects its prominent position in the oil and gas exploration industry. Examining EQT's balance sheet, as of September 30th, 2024, cash and equivalents increased to $88.98 million from $29.97 million in June, largely due to the merger with Equitrans. However, total debt surged to $13.79 billion, raising the debt-to-equity ratio to 0.67, which indicates a higher reliance on debt financing. This significant increase in leverage may impact the company's financial flexibility. Management plans to address this by divesting assets like the NEPA non-operated asset divestiture, expected to generate $1.25 billion to help repay debt. These strategic moves reflect EQT's efforts to balance debt levels while pursuing growth opportunities in a volatile market environment. Here's a screenshot of the full balance sheet. Notably, EQT Corp's total assets rose significantly from December to September. Key investment in property, plant, and equipment shows a strong commitment to operational expansion despite higher liabilities potentially challenging short-term liquidity. EQT Corp excels in preferred stock, outperforming over 99% of industry peers and the S&P 500. Retained earnings to market cap is solid. However, low scores in debt to equity and cash minus debt reveal higher leverage and liquidity concerns compared to the industry. Analyzing EQT Corp's recent income statement, the rebound in gross margin to 43.87% in Q3 2024 is encouraging, signaling improved efficiency in production. However, negative operating and net income margins at -23.16% and -24.72% remain concerning, indicating losses from core operations after expenses. The stagnation in EPS growth at 0% suggests earnings per share aren't improving. Strategic production cuts due to low natural gas prices continue to weigh on profitability. Management's optimism about future margin recovery, bolstered by anticipated pipeline revenues from new assets, is a positive outlook. Yet, ongoing uncertainties in natural gas pricing present risks that merit careful consideration by investors. Here's a screenshot of the full income statement. Notably, depreciation and amortization expenses spiked, impacting overall profitability. While revenue has stable trends, escalated costs suggest operational inefficiencies. For EQT Corp to be a compelling value investment, cost management improvements are crucial amidst volatile market conditions. EQT's low scores in EPS growth and profit margins reveal significant profitability challenges relative to industry peers and the S&P 500. However, the company's SG&A margin is comparatively efficient, outperforming 68% of S&P firms, indicating strength in controlling administrative costs. Examining EQT Corp's recent financials, revenue continues to fluctuate due to strategic production cuts amid low gas prices. In Q3, 2024 revenue decreased to $1.22 billion from $1.37 billion in Q4 2023. More concerning is the net income turning negative, dropping to $300.82 million, signaling profitability challenges. The negative operating income of $281.84 million highlights operational difficulties, possibly stemming from post-merger integration issues. Management's plan to further curtail production aims to align with demand, but this strategy may impact short-term revenues. For value investors, these trends suggest potential risks that warrant careful consideration of EQT's long-term viability. Looking at EQT Corp's cash flow, there's a notable recovery in free cash flow to $23.51 million as of September 30th, 2024, from a significant negative $236.12 million last quarter. This suggests potential stabilization in cash operations. The free cash flow yield of 8.37% is encouraging, indicating decent returns relative to the company's value. However, the capital expenditure margin at -189, 31% raises concerns, as it reflects heavy spending on capital investments that may not be immediately profitable. The high stock-based compensation of $118.93 million further strains cash efficiency. If EQT can manage these expenses, improved free cash flow could enhance its financial flexibility. Here's a screenshot of the full cash flow statement. Notably, EQT's $1.66 billion in capital expenditures raises red flags, hinting at aggressive spending. While operating cash is positive, the need to balance growth investments without straining liquidity is crucial for enhancing shareholder value. In their recent earnings call, EQT Corporation reported significant progress towards strategic goals. The acquisition of Equitrans Midstream positions EQT as the only large-scale vertically integrated natural gas company in the U.S., potentially enhancing efficiency and reducing costs. Over 60% of integration tasks are complete, resulting in $145 million in annualized cost savings surpassing projections. Achieving net zero Scope 1 and 2 emissions ahead of schedule highlights their environmental commitment. While volatile gas prices pose a risk, EQT's ability to tactically manage production may mitigate this challenge. With 60% of 2025 production hedged at $3.25 per MMBtu, they are positioned to maintain cash flow even if prices decline. The $1.25 billion asset sale to Equinor enables debt reduction, strengthening their financial position. Overall, EQT appears poised to navigate risks and leverage opportunities in the natural gas market. Analysts forecast EQT's net income to reach $1.98 billion by 2028, indicating a turnaround after tough times. Earnings per share are expected to grow to $4.80, reflecting improved profitability. This positive outlook is driven by management's efforts to cut debt and enhance operations post-merger. However, the company's success is closely linked to natural gas prices, which are notoriously volatile. This price fluctuation poses a risk to EQT's forecasts, highlighting the need to consider market conditions carefully. EQT's net income is modest, outperforming 42.2% of industry peers and 20.8% of the S&P 500. However, its EPS is strong, surpassing 71.6% of the industry and 88.2% of the index, indicating efficient profitability per share. EQT's PE ratio is notably high at 41, significantly above competitors like Southwestern Energy at 4.6 and Chesapeake Energy at 4.2. Typically, value investors prefer lower PE ratios, suggesting EQT may be overvalued or the market expects substantial growth. Additionally, EQT's PB ratio stands at 2.1 higher than Antero Resources' 1.0. A PB over 1 can indicate a stock is priced above its book value, possibly signaling overvaluation. Management attributes these elevated ratios to macroeconomic uncertainties and geopolitical risks affecting commodity prices. This highlights the need for strategic responses to maintain competitiveness. Investors should carefully consider these metrics when assessing EQT's true value. Our proprietary Bow score reveals that EQT Corp's PE ratio is better than only 27.3% of industry peers and 22.3% of the S&P 500, suggesting a higher valuation. Its PB ratio outperforms 26.3% to the industry, but is strong against the index at 72.8%. The DCF valuation for EQT Corp projects an equity value per share of $86.42 by 2028, driven by significant increases in revenue and capital expenditures. This aligns with management's focus on operational efficiency and cash flow growth despite variable market conditions. The model suggests strong operational cash flows of $6.16 billion. However, fluctuations in long-term growth rates and changes in the company's capital structure could introduce volatility into these projections. Such risks are important to consider when assessing EQT's potential as a value investment in the natural gas sector. EQT's strong DCF valuation surpasses most of its industry and the S&P 500, indicating it may be undervalued. This suggests EQT offers compelling intrinsic value, making it an attractive prospect for investors seeking solid fundamentals at a favorable price. Analysts project EQT stock could rise to $55, but its history of fluctuation from $6.72 to $40. 11 signals volatility. Management's strategic focus is promising, yet reliance on natural gas prices is a risk. Evaluating these factors is essential for potential investors. Our Bow score indicates EQT Corp's analyst targets are weak, surpassing just 8% of industry peers and 7% of S&P 500 companies, suggesting limited optimism from analysts. EQT Corp's significant debt surge raises valid concerns about financial flexibility and liquidity risks. However, their strategic asset divestitures and cost-saving measures, coupled with vertical integration from the Equitrans merger, could position them for future growth. While operational challenges persist with negative net income and high capital expenditures, improvements in free cash flow and optimistic projections suggest potential upside. For value investors, the key lies in weighing the risks of high leverage against the prospects of enhanced efficiency and market positioning. EQT's trajectory hinges on its ability to execute strategies amidst volatile natural gas prices. Make sure to watch another video from our Value Explorer series by clicking the playlist below.